Welcome back, everyone. Thank you for coming to our YouTube channel. Today, we're going to talk about diversify and how do you diversify when you have little funds. Well, first of all, let's talk about what diversification is. Diversification is just basically putting money into different investments to reduce your risk of losing all your money if one investment goes bad. So the way you can imagine that, think of having a pizza. If you put all your investment into one type of security, it's just like having a whole pizza and then dropping it. You lose everything. But if you take that pizza and you cut it into slices and you drop one piece, you always have other slices left so you don't lose everything. Now let's talk about exchange traded funds. We call them ETFs. The beauty of exchange traded funds is that it actually represents a group of stocks. Those group of stocks could be something like the S&P 500, which is about 500 of the big company stocks. So the ETF kind of represents that whole group. Now the nice thing about it, when you invest in an ETF, you instantly get diversification because it's spread out across all those groups. And this overall reduces your risk, which at the end of the day, that's what we want to do. And the nice thing about ETFs is they're cheap by comparison, because if you actually try to buy all those different companies at all the various prices, it'll be hard for you to diversify. But with an ETF, it's cheap and it's easy to buy during market hours. And there are also different types of ETFs. There are some that are value companies, some are like small companies, and other ones that could even be bonds. So by you having all these different types of ETFs, you can mix and match to give you a better diversification of your portfolio. And as I said before, they're way cheaper alternative than actually trying to buy all these different types of securities. Now let's talk about SOXL. SOXL is an ETF that's based off of semiconductors. Now the thing with SOXL, it gives you 3 times the money. So if the semiconductor as a group goes up by $1, you'll go up by $3. Now on the flip side, if it goes down, you're actually going to lose way more money than if you had actually been diversified in the semiconductors directly. Now here's something to ponder. If you look at SOXL on February 21st, 2024, you can see that it's quite bullish. And the reason I say that is because the closing price is above the 50-day moving average and above the 200-day moving average. And if you look down in my description below, I explain how to identify bullish stocks. Okay, so if we look at the chart, we see that SOXL, the low was around $15. That was the recent low. But as you can see, the closing price was $36.14. So the closing price is like $11.14 away from that recent low. Now, the way we can still participate and be able to take advantage of this ETF based on the $15 price, we will go and look into an option chain and look at our puts. And the basic way the put works is that if that ETF was to go down to $15, you're obligated to buy it at that $15. So let's just say we're looking at the strike price of $15, and let's choose the expiration date of January 17, 2025. And as you can see, if you sell this put option to a buyer, you're going to make $1.75 per share. Now, option contracts are in 100 share groups. So essentially, you're going to earn $175 on a single contract. Now, what that requires an investor to do, you have to have about $1,500 in order to sell a single put contract. The great thing is that this option can earn you a rate of return of 12.98%. I hope this helped you understand how I identify investment opportunities. But remember that I'm just a guy on YouTube sharing with you my personal ideas. Please do your own research and consult an investment advisor, as speculating or investing in the stock market carries risks.
Hey, everyone. I need your support on YouTube. Please subscribe to my channel